Okay, we are decoding the numbers as far as Infosys is concerned, and the first headline is on the guidance which has been cut. We were expecting it will be narrowed towards the upper end of the range. It's actually been narrowed towards the lower end. So earlier the guidance was 1 to 3.5%. That's been cut down to 1 to 2.5%. Street was expecting there will be a revision of anywhere between 2 to 3.5%, but actually it's a cut coming in at the upper end of the range for Infosys. Now the guidance stands at 1 to 2.5%. They managed to retain the guidance when it comes to the margin, which stands at 22 to 22%, but there's a definite miss when it comes to the company's top line. This despite the fact that in this quarter there's a beat in terms of revenue growth. The revenue has actually grown by 2.3% on a sequential basis. Remember, we were expecting that the sequential growth on a constant currency basis will be 0.9 to 1%. So there's a beat coming in, a strong beat at that as far as revenues go. The margins too are better than expected at 21.2%, which is an increase of almost 40 basis points. We were expecting a number of around 21%. So even the margins get a thumbs up. And look at the large deal wins as well. $7.7 billion worth of deal wins. The average has been around 2 to 3 billion if you look at the last few quarters, and the street was expecting this quarter the number could be around maybe $4 to $5 billion or maybe 5 to 6. So 7.7 is a very strong number coming in. The biggest question that everyone will have in their mind is now, why the company has gone ahead and reduced the upper end of the guidance despite beating the expectation, and that too quite massively in the second quarter. Of course, attrition must have come down and the other details must have also been positive, but this revenue guidance tells you that they're expecting a deeper furlough in Q3 perhaps and not expecting a big recovery in Q4. Let's try and get the perspective from Mahantesh Sabrad as well. Mahantesh, if you're joining us late, let me run you through the numbers. Revenue has come in at 2.3% sequential growth, margin at an expansion of 40 basis point at 21.2%, and we're also looking at a TCV of around $7.7 billion, but of course the biggest headline is the guidance cut on the upper end. Your read through, Mahantesh.
So these results seems to be all right. A 2.3% constant currency growth is a bit of a positive surprise, I would say. The deal wins are also very good. I'm not too sure why the guidance has been sort of tempered down. I guess that they are also facing, like we had seen in the case of TCS, probably they too are facing a bit of execution issue, ramp downs, and late ramp ups likely to happen ahead. So that seems to be the broader issue for the entire industry per se.
Total employees, it's 3,28,000, which is a decline versus 3,36,294 of last quarter, almost a 7,500 number thereabout dip coming in as far as total headcount is concerned, even sharper than what actually even sharper than what TCS reported, with a cut of almost 6,333 in terms of the employees. Just wanted to bring some more details on board. And as far as the various geographies are concerned, it's North America, which is again remain a bit sluggish. On a year-on-year basis, the growth in North America is just 1% in constant currency. It's Europe which has done well with a 5.4% growth. And if you look at financial services, on a year-on-year basis, there's a sharp slip of 7.3% when it comes to the BFSI vertical. So that's a bit of a worrying point. Communication, which has been weak for rest of the peers as well, seems to be weakening for Infosys as well. However, retail, energy and manufacturing, that is what is holding out okay. And healthcare and life sciences as well has been doing well for TCS. Ditto can be said for Infosys as well. If you look at the Q2 performance, it looks like a beat on all parameters because the constant currency growth came in at 2.3% versus our expectation of 1%. The margins came in at almost 21.4 versus the 21.2, I beg your pardon, versus expectation of 21, and the profitability too looked better than our expectation. Not to forget the fact that the deal wins were solid at $7.7 billion. Then why that 4.6% cut that we are seeing in Infosys area, which is trading in the US market right now? Well, the reason is that there is a sharp cut in guidance. The guidance now stands at 1 to 2.5% versus 1 to 3.5% that was earlier. A bigger disappointment because Street was expecting that the lower end of the guidance will be raised upwards. That hasn't happened. Secondly, if you look at the internals, the headcount has actually dropped by 7,530. Another bad news spelling in That tells you that perhaps the management does not have too much confidence in terms of the near-term visibility, and hence they are staying away from adding more costs, and perhaps don't want to have a bench strength when the order inflow and execution isn't really picking up. So that's the latest that we have for us. The guests on the show were talking about how there seems to be a bit of a dichotomy, and the fact that there might be some cuts that might come in place for Infosys, given the fact they're expecting the second half of the year to be slower than the first half.